Good morning, Trinidad and Tobago, and welcome once again to the Bourse Report. As always, following the budget, we have a look at the financial and investment implications for you as an investor arising from the budget. So, no need to rehash what has been said so many times before over the past week. Let's look at specific areas that will have an impact on you as an investor. But just to start off, let's look at what has happened with regard to revenue and expenditure for fiscal 2018. As you would see, revenue projected at 45.7, expenditure at 50.5, and a fiscal gap or financing that will be required by borrowing of $4.8 billion. This does not tell the whole story, however, because this represents recurrent revenue versus recurrent expenditure. There is a class of revenue that is to be generated from what we would call one-off asset sales. Some of these include, for example, the sale of CL Finance and CLICO assets, which have not been specifically named, to cover off a $7.5 billion additional requirement, or should I say a requirement that is embedded here, but it only includes one-off. So what it means essentially is that when you take recurrent revenue versus recurrent expenditure, there is still a gap of about $4.8 billion plus another $7.5 billion, which makes it somewhere about $12.25 billion in seeking to fund the difference between recurrent revenue and recurrent expenditure. So one of the measures that have been discussed is the sale or the placement of certain Angostura shares into a fund which was dubbed the National Mutual Fund. And that fund, as you would see, constitutes Angostura, which is some 61.67 million shares at the going price of about just above $15, $15.23 is what it's closed at. It would generate some $939 million. We don't know much about the HCL because it is not a listed stock, but we are told that some 16% of HCL will be divested into this fund, generating from some $460 million, or this would constitute the $1.4 million. Opportunity for investors at the right price, so look out for this as it comes to market in terms of a national investment fund, probably in similar vein to what you know as the CLICO investment fund listed in the mutual fund tier of the stock exchange. Let's look at some other areas now. Now, one of the critical measures that have been put in place this year is what I would call the surplus tax on the various banks. The three largest and publicly listed being First, Republic, as well as Scotia. And when you look at some of the numbers, and I'm just presenting a scenario here, taking a snapshot at what would have been the profit before tax at their last respective financial years. And when you adjust down, what you will see is the profit after tax adjusted would fall somewhat. And essentially, lots of numbers on this particular chart, but the main point about it is that if you take a snapshot and you adjust for higher taxes, your profit after tax and your earnings per share will fall. What could this mean? This could mean that the valuation of your holdings now, holding everything else constant, the value of your share could fall in these listed areas because your profit after tax from the company will fall on a static basis and the earnings per share will fall. These are implications for the market, the implication being that you could find a falling off the market because prices caused by taxation is going to reduce valuations, at least in the listed banking sector. Let's look at some of the other implications. particularly for the investor, what is going to happen to interest rates. And interest rate would be dependent upon, one, the credit rating of the issuer, that is the country, and two, what is happening with demand and supply for money in that medium-term space, 10 to 15 years, where government is expected to borrow directly from the market some $4.75 billion. But we also need to take into consideration the statement made by the Honourable Minister of Finance with regard to what he proposes to do with regard to Petrotrin and Petrotrin's borrowing of some $850 million US, which comes due in 2019, but his indications are that he's looking for an early refinancing, and that was discussed to some extent in the budget. So what does this chart speak to? As one metric for the cost of financing, which goes into the cost of financing or the cost of borrowing, is of course debt to GDP. As that rises, the capacity to borrow more is reduced, and it impacts the credit rating of a country. So what has been happening since September 12th? Our debt to total GDP is going up. And it is expected, based on the borrowings for the end of 2018, that our debt to GDP will hit the threshold that has been spoken about by the Honourable Minister of Finance and indeed the Prime Minister in earlier statements, that we do not want to pass the threshold of 65% debt to GDP. And that is going to happen given the statements that have been taking place and given the expectations with regard to GDP or nominal GDP going forward. So we've reached a threshold. It is going to impact interest rates, certainly in the international sector, for which we do not plan to do any much borrowing except for Petrotrin. And this particular, shall we say, purple or mauve figure here shows that if we had to refinance Petrotrin to the extent of $850 million US, we are going to be above that threshold of debt to GDP. That magic number of 65% is going to be passed, and we're going to be closer to 70% if we have to do that financing. It's going to impact credit rating. It's going to impact the cost of borrowing. So some things to look forward to, let's say, not this, but to look forward to would be what's happening with regard to interest rates and inflation. For the investor over the past years, in 2014, if you look at this particular graph, what you would see is that headline inflation was about 7.8%, and what you were getting on a bond was 2.5%. This is a 10-year or 15-year bond. Fast forward now to what's happening into 2017. Inflation has fallen to 1.4% headline inflation, and the return on the bond, the yield on the bond is 4.6. What it means, you are now getting a real rate of return, whereas before you had a negative real rate of return, so you are getting a real return on your investment. That is, at least for inflation, relative to inflation in the short term. One cannot say over the entire period what that would be. These are some of the thoughts that we share with you. We can provide you with more detail and advice with regard to interest and what's in it for you. Look for us in the newspapers where we talk about our various mutual funds under Bourse and the rubric Save Invest. Have yourself a wonderful investment week. This is Subhash Ramkilawan for the Bourse Report.